better understand your business, sometimes you need a different perspective. One that takes nothing at just its face value. That dives deeper into detail to find deeper truths and greater insights. And at Deloitte, this is just where we begin. Connecting the brightest minds with effective processes and world-class technology, we go beyond expectations to deliver the highest quality audit and assurance services. We focus on the detail so you can see the bigger picture. Deloitte, beyond the expected.
Hello everybody, I'm Mike Hartwell, Head of Audit and Assurance in Deloitte, and I'm absolutely delighted to welcome you to this year's All-Ireland Deloitte Financial Reporting Plus Conference. You know, once upon a time, this conference was about changing in accounting standards and how we apply them. This was a simpler time. Today we see changes coming from many directions on many topics and at a pace that we had not previously experienced. It's no longer good enough just to focus on a singular topic like accounting standards without understanding the much wider environment. This year alone, we continue to see so much change and challenge as we try to navigate through the pandemic. So 18 months on, it's really easy to forget about some of the other forces across our environment that are causing change. So at the DFRP conference today really reflects this. Not only will we be talking to you and taking you through the latest in financial reporting, but we also aim to equip you with insights around key topics such as cryptocurrency, data protection, climate change, the latest updates in tax both north and south of the border. We've done our best to address these topics and pressing issues with you today. We have a lot to cover in the next 90 minutes or so, so our aim is to give you clear pointers to guide you through. We will provide you with follow-up material, including today's slides, a recording of the session, all sent to you via email and housed in our Deloitte Financial Reporting Plus webpage, which will go live later today. At the end of the session, we'll ask you to complete a short survey. Your feedback is really important to us. We learn a lot from it and it really helps us shape future sessions. Also, if you have any questions in the session, please use the comment box on the right and the team will respond to you. I'm now going to hand over to Harry Goddard for some insightful perspectives for the CFO from the desk of our CEO.
Good morning, everybody. I'm really pleased to be able to welcome you to this year's Deloitte Financial Reporting Plus Conference. It will be great to be able to welcome you in person in our usual setting of the Convention Centre, rather than standing in front of a camera. But hopefully next year, we might be able to elbow bump in person. It's a busy agenda for today's event, from climate to cryptocurrencies, and from data protection to the latest financial reporting standards. It's a real sign of just how broad the scale of the finance function's remit is. As a non-accountant, I've always admired your profession. And in particular, I've been impressed, if not a little jealous, by the impact the CFO or the finance function can have on a business. You wield incredible power. I heard Lou Gerstner put it best. As the former chairman and CEO of IBM, he is generally credited with turning IBM's fortunes around during his tenure from 1993 to 2002. He explained that the CEO at the beginning of the year would state their strategy, make their rallying call to the organization about where it was going and how it was going to get there, with language that was ambitious and aspirational. Then, about halfway through quarter one, when revenue was slightly below plan and expenses were slightly above, the CFO would come out and cut all expenses and instruct people as to where they could find the revenue growth. Nobody could remember what the CEO said. His story, like many others I am familiar with, illustrated the strong controllership aspect of the finance function, often referred to as that part that was really good at just saying no, if even to the CEO. It's a nice story, but the reality, as I think we all know, is that it's not quite like that. The second most important executive in most leadership teams is the CFO. The most important relationship on the executive is between the CEO and the CFO. At least that's what I thought. And then the pandemic struck. cash flow, liquidity, working capital, debtors, performance data, insight to customer and supplier performance. This information became necessary like oxygen. I spoke to a lot of CEOs during the first months of the pandemic, and, like me, this was their priority. Most of them had transitioned to remote working successfully. They had put the structures in place to support and look after their people. In those first few weeks of the pandemic, we talked about V's and W's when we speculated on what the recovery would look like. Nobody knew what a K was. Governments and businesses everywhere decided that austerity wasn't the answer. We breathed out a little, but only a little. You, as the life support monitor in every business, were working overtime, analysing, assessing, inquiring, reconciling. You worked hard to ensure the necessary bank facilities were in place. You supported decisions on whether to apply for state support, perhaps a double-edged sword. You analysed the cost base for efficiency or cuts. You constantly monitored the performance of the business. Then we discovered what a K-shaped recovery was. I met with businesses in one of three categories. The first had seen no negative economic impact from the pandemic. In fact, they'd only seen positive ones. Maybe they were in life sciences or technology. The second group had been catastrophically impacted by the pandemic. Maybe they were in hospitality or tourism. However, the majority were in the middle. All of these businesses had major decisions to make. For some, it was how to protect and preserve what was good until the economy recovered. Their potential was linked to their previous decisions and readiness coming into the pandemic. However, for most, it was where and how to invest, where and how to be conservative, and where and how the business was going to transform and grow. Growth and transformation became critical to businesses. It was how they were going to make their way out of the pandemic. Suddenly, the finance function, which had been so critical as the life support monitor, was just as necessary, but was being called upon to do even more. Businesses needed their finance function to adapt, to provide the insights to support strategic investments and change in the business. They needed a finance function that had the tools, the data, and the talent to support a wide range of short and long-term commercial decisions. We have seen unprecedented levels of investment in the Irish economy over the past 12 months, with no sign of that abating, and with significant growth rates forecast into 2022 and beyond. This period of investment, transformation, and growth is set to continue. As an example of this, we've seen M&A deal volumes reach such high levels this year, and a significant feature of this has been the significant private equity investment in the market. In fact, the value of this has leapt by up to 477% year on year to a total of 9.8 billion in the first 6 months of this year. What's more, the Department of Finance, in advance of last month's budget, outlined that modified domestic demand is projected to grow by 5.25% this year, and by 6.5% next year, with much of the rebound driven by increased consumer spending as households begin to spend more and save less than they were in the height of the pandemic. All in all, we are in a new age for our economy, our environment, and for the CFO and their team. Having come through the pandemic, a once-in-a-100-year event that disrupted practically every business across the globe, exposing the interconnectedness and fragility of our global economy, you now know your businesses better than you have ever done. If you're in a business that has seen investment, transformation, and growth, you have played a critical role in enabling that. If your business is slowly emerging from the hibernation of the pandemic, tentatively exploring your new environment, you have played a critical role in that. I mentioned at the start of my comments that the second most important executive in most leadership teams is the CFO, and the most important relationship on the executive is between the CEO and the CFO, and that was what I thought until the pandemic struck. I am now confident in what a fundamental truth that is, and a good job too. Cryptocurrency, ESG, data protection, tax changes, the world isn't getting any less complex, and businesses will require a deft hand on the rudder to navigate future disruption and change. As a former consultant in my previous career before I became CEO, we had a tool, like a compass, which we used to guide CFOs in thinking about their careers. I've been reminded of this tool often as I've discussed these very issues with CEOs and CFOs alike in recent times. This tool, just like a compass, had 4 points: operator, steward, catalyst, and strategist. It reflected the 4 roles that the CFO and therefore the finance function must be able to support. As a steward, working to protect the vital assets of the company, ensuring compliance with financial regulations, closing the books correctly, and communicating value and risk issues to investors and boards. as an operator, to operate an efficient and effective finance organisation providing a variety of services to the business, such as financial planning and analysis, treasury, tax and other finance operations. That bit that's good at saying no. As a strategist, taking a seat at the strategy planning table and helping influence the future direction of the company, providing financial leadership and aligning business and finance strategy to grow the business, including, for example, M&A and capital market strategies. And as a catalyst, stimulating and driving the timely execution of change in the finance function or enterprise, using the power of the purse strings to drive business improvement initiatives such as cost reduction, procurement, pricing execution, and other process improvements and innovations that add value to the company. Steward, operator, strategist, catalyst. Having the capacity to operate across each of these 4 points requires a finance team that has the technology, data, and talent in place. It reflects a significant shift in emphasis for many CFOs and finance teams as they build on their experience through the pandemic as their CEO's lead advisor. We cannot declare the pandemic to be in our rearview mirror, but we can see our way towards the post-pandemic world, which will be different for many of us. Use today to reflect on all that you and your teams have achieved, to gain some insight into what the future holds, and to plan for how you will play your part in leading your business through that future. I really do look forward to meeting you in person soon. Until then, I wish you all continued success as you play that critical role in really driving your business forward. And with that, it's time to dive into today's agenda, and I will pass you over to my colleagues, Michelle Byrne and David McCaffrey, who will outline to us how we can put climate on the agenda.
Thanks, Harry. Hello, my name is David McCaffrey and I'm a partner in our Audit and Assurance Financial Services Department. I work with a number of clients across a number of sectors, and a consistent theme that is in all of our agendas is trying to understand the impact of climate on businesses and on financial reporting. Myself and Michelle Byrne, a director in our Financial Reporting Advisory team, will touch on some of these key developments.
Yeah, thanks for the introduction, Dave. Yes, I totally agree. Climate has been such a hot topic recently, especially with the recent Ireland Climate Finance Week and COP26. I know I have seen a large number of my clients beginning to tackle this. And Dave, you work with a lot of large listed clients as well. So what are you seeing in terms of activity around sustainability reporting?
Great question, Michelle. I think we've all seen in a short number of years the dramatic shift in the number of companies reporting on sustainability. Not only has this shift been driven by local laws and regulations, but also the growing importance of environmental, social and governance matters on a company's business, their identity and their financial performance. Investors are wanting and demanding more transparency on the impact of climate change and climate risk on the financial statements. And we've seen regulators take a real keen interest, with IASA and the FRC having reviewed a number of listed companies and issued findings on the disclosures in relation to climate change. Recently, the FRC has issued a helpful guide on Tcfd disclosures. One of the key considerations is that preparers provide a robust and clear disclosures on the impact of climate matters on the financial statements. This includes disclosures of the significant judgments and estimates that could be materially impacted by climate-related risks. If climate change or climate risks are identified in the front half of the annual report, what does this mean for the back half in terms of the accounting judgments and estimates? Basically, there is a real focus on consistency of disclosures between the front half of the annual report and the financial statements. For example, a lot of companies are making ambitions about being net carbon zero by a certain date, but publishing little or no information on how they're going to achieve that target, what impact it will have, for example, on the viability of the company, the going concern, or even the capital expenditure required. Michelle, I'd be really interested to get your perspective from your interactions with clients. What are the questions they're asking you?
Well, to be honest, Dave, the first thing I'm often asked is whether or not there is an actual standard that specifically focuses on climate accounting. The simple answer is no. There is currently no IFRS standard specifically focusing on it, but existing standards do need to be considered. There are a large volume of standards which need to be considered, and a lot of potential areas impacted in the accounts. So firstly, when I'm speaking to my clients, what I always do is I normally bring a number of documents to their attention. These are my go-to documents, and definitely really good documents when you're starting out. The first is a paper by Deloitte. It's available on IAS Plus, and it looks at the impact investor demands have for increased transparency on climate. It also covers some of the key accounting impacts in respect of climate and what you need to be looking at. The other documents are two guides issued by Climate Disclosure Standards Board, the CDSB. They were issued in 2020 and 2021, and both of these provide plenty of useful examples of where climate risks impacts existing standards.
Michelle, those are really good documents. What are they actually telling us about the financial reporting considerations?
Yeah, so they cover quite a lot, Dave, so they do, and there's really quite a lot of detail in them and the different areas that are impacted. So rather than trying to go through them all here today, what I might do is signpost the key areas that my clients are grappling with and my clients are looking into. The first area is in respect of the impact climate risks have on the impairment of assets. So during the impairment process, consideration needs to be given to building climate risks into your value and use calculation. So for example, some of my clients have been considering what impact will climate have on their customer preferences and the technology that they use, and how does that actually impact on their revenue and growth assumptions. The second area is how much cost do they need to build in for the cost of increasing costs of compliance with new policies or legislations, or for example, in respect of carbon budgets, stricter environmental controls, or interestingly, the increasing cost of insurance due to climate factors. The second area I want to draw your attention to is in respect of the impact on the useful economic lives of assets. So again, interestingly, not one that people would commonly think of. For example, in order to meet emission targets, companies may need to replace some of their assets with equipment that is more energy efficient or powered from alternative sources. This may have an impact on the existing equipment's useful economic lives and requires that my clients revisit these accounting estimates around these useful economic lives and account for them prospectively. The third area of impact is in respect of liabilities. And I've started to discuss this more and more with my clients as they look at the provisions and the impact of provisions and contingent liabilities are having. So for example, if you have new obligations as a result of failing to meet climate-related targets or fines in respect of climate-related targets, you may need to build this into your calculation. Or in respect of asset retirement obligations due to the changing timing of the decommissioning of the assets. For example, in that previous example, due to the shortening of the useful economic lives. And again, linking back to what you said earlier, Dave, I think it's a really good point and something that you need to focus on for the coming financial year end. That's that IASA and the FRC will be focused on the disclosures of climate-related risks in these areas. The last area of accounting that I have seen significantly impacted by climate is the financial instruments area. But given this is your background, or a little bit more in your background, perhaps you could give us a flavour of what you're seeing around this.
Yeah, sure, Michelle. Climate risk is a consideration for IFRS 9 and IFRS 13. For example, if we're determining the fair value of an asset under IFRS 13 using, let's say, future cash flows, these forecasts could look very different if global temperatures increase by 1.5 degrees compared to 3 or 4 degrees. These scenarios could result in a change in customer preference or behaviour, which will ultimately impact the forecast and then the fair value of the instrument. There is also a lot of investor appetite for green products and investments out there. Locally, we have seen the main Irish banks issue green bonds to the market with strong demand from investors, with these funds being used for specific lending, such as green mortgages. Although we mainly talk about the risks today, being financial accountants, there are huge opportunities for businesses to thrive through this period of change.
I love hearing that, Dave, and I think that's really important to remember that while there are some risks to consider, there are fortunately even some opportunities out there. But looking forward to the 2021 year end and financial reporting period, what do companies need to start doing now to get ready for that?
For sure, and there are a lot of frameworks, a lot of acronyms bouncing about in regards to financial reporting and climate change. Firstly though, for clients who report under the existing non-financial reporting directive, there are increased disclosure considerations required for 2021 and 2022 in regards to the new EU taxonomy disclosure requirements. And this is something to get ahead of now. For FY21, there are certain disclosure requirements and there are limited versus the full taxonomy, with the full taxonomy coming in for FY22. One caveat, however, the taxonomy has been approved by the EU Parliament, but is now with the Council of Ministers, and they have until the 8th of December to object. If it is objected, it could cause a delay in the implementation, but we think this is going to be unlikely. I guess, Michelle, is there anything further you want to add or highlight in relation to financial reporting? The
last area that I want to highlight is you've already spoken about, I suppose, the TCFD disclosures and the impact that's having. But the second area, and another acronym, is CSRD, so the Corporate Sustainability Reporting Directive. The CSRD is the new EU directive, which is going to replace the existing non-financial reporting directive and will require mandatory assurance on the sustainability information in the annual report. This directive will see a significant increase in the number of companies caught in scope by the requirements. But fortunately, it doesn't come into effect until FY23. And so for today, I just want to flag it and bring it to your attention and note that there will be more information coming out on this in 2022. Right now, I want to thank you all for your time. We'll now introduce you to Jack, who will take us through digital assets.
Thank you, Michelle and David. My name is Jack Lee, and I'm a director in our audit and assurance practice, leading our sustainability and digital asset reporting and assurance team. Welcome to our next session, which is focused in on cryptocurrencies and digital assets. Today I'm going to try and demystify what digital assets are, give an overview of the latest market trends, and provide some insight into the accounting challenges related to digital assets. So let's get right into it. What are digital assets? A digital asset is defined as something that is represented in a digital form that has intrinsic or acquired value. While digital assets are most commonly associated with cryptocurrencies such as Bitcoin and Ethereum, digital assets are much more diverse and can be used for a variety of purposes. So aside from the cryptocurrencies that you're familiar with, other examples include utility tokens, which are assets that people buy with the intention to use for something in the future. A simple example of this is where a company is developing an online game, could issue a utility token to fund the development of that game. Other types of digital assets include specific asset-backed tokens like commodities, land and property. You've also got general-backed tokens, and then you've also got currency-backed tokens, which are called stablecoins. Stablecoins are designed to minimize the volatility of the price of a stablecoin relative to a stable asset or a basket of assets. So a really good example of this is a USD-backed token, which is backed to the US dollar, and generally the value of that token is around $1. As we move forward into the future, what we're seeing is more and more types of digital assets. So we're seeing tokenized debt, equity, and financial instruments. And we're also seeing a number of regulators and central banks now start to look at central bank digital currencies, or CBDCs, which is a digital form of cash serving as both a medium of exchange and also a store of value. 70% of central banks are now exploring CBDCs, and the EU is also currently exploring the digital euro. So what does this mean for the market in terms of activity? There's been huge activity in digital assets in 2020, and this trend has continued into 2021, which illustrates the growing demand for digital assets. Suppose if we take a step back and we look to 2009, when Bitcoin was the first digital asset, it had very little value. In 2013, the overall market cap of Bitcoin reached 10.5 billion. In 2015, Ethereum or Ether was launched, and a couple of other alternative coins, which increased the market cap of digital assets to 17.8 billion in 2016. And in the last 5 years, what we've seen is the market cap of digital assets reach over 2.5 trillion at its peak in 2021. And this is a phenomenal increase in terms of the market cap in just over 5 years. So what does this actually mean? In terms of the types of digital assets, there's currently over 13,000 different types of digital assets being traded on 424 exchanges. The average daily trading volume of the top 10 exchanges is currently over 177 billion, and this is up from 27 billion in January of this year. That's a daily increase of over 500% in the daily trading volumes of digital assets. And this is down to exchanges providing new services like derivative crypto trading, lending, borrowing, and staking, which ultimately creates new liquidity and new markets for investors. The pandemic has accelerated the transition to digital payments as more and more customers are using cashless transactions. And what we're seeing is that digital assets offers many users many benefits, including being able to tokenize physical securities, which allow for easier and more frictionless trading on secondary markets. They also provide a degree of transparency, a record of provenance, and because digital assets will allow traditionally non-indivisible large assets to become more divisible, so for example land and property, they effectively create a more inclusive and accessible trading ecosystem for institutions and retail investors. Therefore, it's no surprise that respondents from Deloitte's annual blockchain survey in 2021 viewed digital assets as very favourable. 85% said that they believe digital assets will be important to their industry in the next 3 years. And in fact, 76% of the surveyed respondents said that they strongly believe digital assets will serve as an alternative to or an outright replacement for fiat currency in the next 5 to 10 years. In the same survey, 81% are very much in favour of a digital euro issued by the euro system. Now, I suppose just to give you an idea in terms of who currently holds digital assets, it's pretty evenly spread amongst retail, institution and high net worth individuals. And these are all the traditional holders of digital assets. What we're seeing now is more and more corporates are starting to invest into digital assets. So you have companies like Tesla and MicroStrategy holding Bitcoin on their balance sheet. And actually, by holding these digital assets on their balance sheet, actually creates a number of accounting impacts and considerations that corporates need to think about. So let's look at some of those accounting impacts. I suppose the first thing to note is there's currently no standard that can be used to account for digital assets. We need to look to all of the traditional accounting standards to be able to account for digital assets. And I suppose one of the most obvious questions is a digital asset considered cash under IFRS? IAS 7 defines cash as cash on demand and demand deposits, and cash equivalents as short-term, highly liquid investments that are readily convertible to known amounts of cash that are subject to insignificant risk of change. Digital assets, are they considered notes, coins? Are they considered rights to notes and coins? And I suppose the answer is likely no. Ultimately, the holder holds a key to an address in a blockchain that can be used to facilitate peer-to-peer transactions. And although it is possible to convert the digital asset to cash, perhaps through a digital asset exchange, the holder does not specifically have a right to cash. So if it's not cash, what can a digital asset be, how can a digital asset be accounted for? It could be considered an intangible asset. IAS 38 defines an intangible asset as an identifiable non-monetary asset without physical substance. A digital asset has no physical attributes and therefore can be in the scope of IAS 38 unless it's being held for sale in the ordinary course of business, which we'll discuss on the next slide. In accounting for a digital asset as an intangible asset, you must consider, do you have the legal rights and obligation to that asset? If you do, then you would recognize it on balance sheet and then measure it initially at cost. Subsequently, you can measure the digital asset at cost or a revaluation model. When the cost model is applied, the digital asset is carried at cost less any accumulated impairment losses. Those impairment losses would be recognized in the P&L. And I suppose the other thing to note is that a digital asset is an indefinite life intangible and therefore it would not be amortized over the life of the asset. IAS 38 does allow for an intangible asset to be remeasured using the revaluation model as well, but this is an accounting policy choice and only if there's an active market for the digital asset. So this is a key question and a key consideration. There are a number of different things and different digital assets. Some are more liquid than others, and therefore we need to think about, what type of digital asset do we hold. If it is being, if the revaluation model is being used, any fair value increases above the cost are recognized in OCI. They're never reclassified into the profit and loss, and even when the digital asset is sold, it's not reclassified into profit and loss. On the other side, any fair value movements below the cost would be recognized in P&L. So this has a significant impact on potentially the earnings per share and also on any profit before tax that companies might be thinking about in terms of their ratios. So what other way can digital assets be accounted for? As I mentioned earlier, if they are held by an entity in the sale of the ordinary course of business, they could be classified as inventory. So although they might meet the definition of IAS 38, they would fall into the scope of IAS 2 inventories in this case. And I suppose the key thing to note here is that businesses will need to do a detailed business model assessment to determine whether those digital assets are actually held for sale in the ordinary course of business or are they held as an investment. If they are considered inventory, they're measured at the lower of cost and net realizable value. And there is one exception to this, where if an entity is considered a commodity broker trader, and if that is the case, then the inventory can be measured at fair value less cost to sell. And I suppose if that is the case, then IFRS 13 applies and all of the IFRS fair value measurements need to be thought about. And any of those changes in those fair values then will go through the P&L. Lastly, what we're going to look at is some considerations around revenue recognition. And there are a number of different things to think about here. The first is, how are transaction fees recognized? So if we take the broker-trader example, are you a principal or an agent under IFRS 15? And I suppose a detailed assessment will be required to determine how you would account for the revenue for each company, and this will be different for every business. The next consideration might be, how would you treat an initial coin offering? Depending on the rights and obligations and rewards attributable to that token or that coin, the company may have potentially deferred revenue liabilities or a liability to the holders of those tokens, and I suppose then they might need to get recognised as those tokens or coins get extinguished or used. Hopefully that gives you a little bit of insight in terms of some of the challenges relating to the accounting for digital assets, and hopefully it gives you a little bit of overview of the rapid pace of change relating to digital assets and where the world is moving towards. Finally, what I'm going to do is I'm going to leave you with some of our links and to our thought leadership on some of those accounting impacts that I talked about, as well as some of those surveys that we've completed on the trends relating to digital assets. Thank you, and I'm now going to hand you over to my colleagues Dipna and Megan, who will discuss the must-know IFRS developments for 2021.
Thank you so much, Jack, for your introduction. Hi, my name is Megan Haldane.
Hi, my name's Dimna, and we're senior managers in the Financial Reporting Advisory Department here in Dublin. So it's coming up to year end. Megan, I'm just wondering, is there any areas in your financial statements that you're planning on focusing in on?
Well, Dimna, that's actually a really good question. So luckily for us, effective 1st of Jan 2021, there are only a couple of narrow scope amendments that we need to be aware of. The biggest one that I'm focusing on at the moment is the interest rate benchmark reform phase 2, which is effective this year. As I'm sure you've heard, there has been quite a bit of manipulation within the various banks with regards to the different interest rates. So specifically, LIBOR is all being replaced mainly by the end of this year, as well as some effective next year up until 2023. So what I'm looking at the moment is my various contracts, specifically my financial instruments, as well as my lease contracts, to see if any of the interest rates are linked to LIBOR. Because if they are linked to LIBOR, this amendment is going to be very applicable to me, as I will have accounting and disclosure implications. There are so many nice practical expedients within this amendment, but in essence, what will happen is I won't have any negative impacts on my income statement if I do have any changes to my interest rate going forward due to the change in LIBOR. I have a really, really nice example that I'll send to you and I'll put up on the DFRC website that you can have a look at, looking at the different implications due to this narrow scope amendment. I'm also really keen to hear what Maeve and Grace have to say about the implications of LIBOR as well as the IBOR reform phase 2 and how that impacts UK and Irish GAAP later on.
And I suppose, Megan, we should probably also think ahead to 1 January 2022. I know there's a couple of narrow scope amendments that are effective at that point. So for example, IAS 37, which is the accounting standard relating to provisions, contingent assets and contingent liabilities, is being clarified to assist reporters determine what they should capture in their cost to fulfil a contract. And this is obviously important when you're doing that. Do I have an onerous contract test? Something else as well, IAS 16 has another narrow scope amendment, and this narrow scope amendment prohibits reporters from offsetting proceeds that they've earned from items of property, plant and equipment prior to them to being brought into their intended use by management. So those proceeds now have to be recognised in the profit and loss account.
Very interesting. While you're talking about the future amendments, the one that I've also noticed effective 1st of Jan 2023 actually relates to the classification of current and non-current liabilities. I know this has been a big topic under the IFRIC as well as the ISB agendas to make sure that users and preparers of the financial statements fully understand how this narrow scope amendment will implicate their financial statements, especially on how to classify liabilities with covenants between current and non-current.
And then just thinking on 1 January 2023, the new insurance contract, IFRS 17, is effective as well. It's probably important that we don't just think this is just for insurance entities. So I know on my radar, I'm thinking about some contracts I have that might actually meet the definition of an insurance contract. And something that's really helpful to note is paragraph 7 of IFRS 17 includes a number of scope exceptions, and those items may actually meet the definition of an insurance contract, but they're scoped out by virtue of that paragraph. So an example here might be warranties. If a warranty has been issued by a manufacturer, a dealer or retailer in relation to the provision of goods and services to a customer, then that's scoped out of IFRS 17. However, if that's not the case, you could fall within the standard, and then you'd have to consider the recognition and measurement models that are included in there.
Oh wow, I didn't actually know that. I'll definitely make sure to keep an eye out for that. While we're talking about our financial statements and financial reporting, I think something really important to make sure that we are keeping an eye out on is what our accounting enforcers are discussing. I do know generally our accounting enforcers release a lot of good thought leadership and thought products that we should be making sure that we're keeping an eye out on for our financial statements. One of the ones that I have a key focus on is the FRC. They've released a good couple of thematic reviews in the last 12 months. Some of the nice ones that I've seen relate to IAS 37, provisions, contingent liabilities, and contingent assets, alternative performance measures, as well as the going concern and validity of different reporters. And I think this is such a key thematic review, especially given the uncertain times that we are hopefully starting to come out of with the easing of restrictions due to COVID.
Yeah, that's a good point. And I know there's a couple of common themes with the regulators, but definitely based on my reading of IAS's Observations 2021 report and ESMA as well, there's some additional themes coming through. So for example, the expected credit loss on financial assets within the scope of IFRS 9. I know that the impairment of assets, if you're looking at the guidance on IAS 36, is a theme, and even operating segments, just to name a few. I suppose though also we can't forget about the IFRS Interpretation Committee. They've definitely been really active recently. Something that comes to mind is the cloud computing arrangements. So firstly, over the last couple of years, there's been a number of communications from IFRIC in relation to both the classification of these types of arrangements and more recently in relation to how you account for the upfront implementation costs associated specifically with cloud computing arrangements that are classified as service contracts. This is definitely something that's really important to think about because it could have an impact on not only your accounting policies, how you present your financial statements, but also your cash flow statement. Now, luckily, Deloitte do have a document which we'll be sharing in these slides, which goes into a bit more detail on that specifically.
Great, that would be really interesting to read. While you're discussing the IFRIC, one of the ones that I read about was with regards to inventory. As you know, inventory should be recognized at the lower of cost and net realizable value, and net realizable value is selling price less costs of disposal. So the IFRIC was actually asked the question about when I'm looking at these costs of disposal, should there only be incremental costs that I should be considering? They actually came back and said that you should be looking at all costs that have been incurred and not just incremental costs. This is quite an interesting concept because there might be some diversity in practice because this would bring into account all your fixed and overhead costs, which might have an impact on how you're calculating your NRV going forward. While I was on their website, I also saw some really interesting open agenda items, specifically relating to cash and cash equivalents, which we definitely need to make sure that we're keeping up to date with. They relate specifically to deposits with restricted use and whether this can be seen as a cash and cash equivalent, as well as EFTs. And when do I recognize an EFT as a cash and cash equivalent? Is it on initiation or on settlement when I'm receiving this cash for a settlement of my financial assets?
And something actually I've been reading recently is the ISB's discussion paper in relation to businesses under common control. So this is really topical at the moment and another area of diversity in practice. The deadline for comments on the discussion paper was September this year. So currently in IFRS, there is no recognition and measurement guidance in relation to these types of transactions, which is where the diversity in practice is coming from. IAS 8, which is the accounting standard relating to changes in accounting policies, estimates and errors, details that if you don't have sufficient guidance within a particular IFRS standard, that you can consider the wider standards within the framework. And on failing to find sufficient guidance there, you're actually permitted to revert to another framework, which is what people have been doing on this particular topic. So I know that I've seen people apply acquisition accounting, which would require them to do a fair value exercise and potentially recognise goodwill on the transaction. Whereas other reporters have actually been reverting to Irish GAAP, specifically Section 19 in relation to group reconstructions, and others have been referring to US GAAP, ASC 805, which provides some common control accounting guidance. If you are reverting to Irish GAAP or US GAAP, then the accounting that you would apply would be to recognise the assets and liabilities acquired at the net book value based on what the seller had recorded them at. So this removes that requirement to do that fair value exercise and also means that no goodwill would be recognised on the transaction. I understand the ISB are involved in this project, first of all, to reduce on the diversity in practice, and secondly, to provide investors with more meaningful and comparable information.
Oh, definitely, that will be a very interesting project to keep an eye out on. I also know one of the big ones that they're currently working on are their primary financial statements and disclosure projects. And I think that's an important project to make sure that we are keeping a watch on, because this could have huge implications for IS1 going forward, as well as what our financial statements look like from your statement of profit and loss, your cash flow, as well as where everything sits within your notes to your financial statements. So definitely something that is very interesting to see where the ISB will go with that. I do know one of our ex-Deloitte partners, Andreas Barclove, was actually appointed as the chairperson for the ISB in July. So I'm very interested to see where he takes the existing and any new projects that he puts onto the agenda of the ISB during his tenure.
So there's definitely a lot to think about, Megan. On the positive side, though, there is a lot of resources out there. So I know there's the Deloitte Model Financial Statements, there's the Deloitte Accounting Research Tool, IS Plus, and even these slides will be made available on the DFR Plus website.
That's great to hear. Thanks so much, Japnel. I think this will help our financial reporting at year end so much. So very much looking forward to all of these new amendments. And I'm looking forward to what Maeve and Grace have to say about the implications from a UK and Irish gap going forward.
Absolutely.
Thank you, Dimphna and Megan. My name is Maeve Colton and I'm a Senior Manager in our Audit and Assurance Department in our Belfast office.
And my name is Grace Carton and I am a Director in the Audit and Assurance practice also based in the Belfast office. We are here to provide an update on financial reporting standards outside of the IFRS regime. We are going to cover two areas, updates to FRS 102 and the streamlined energy and carbon reporting regime that applies to large UK companies. Looking to FRS 102, the updates impacting 2021 are relatively minor in nature. The amendment for temporary rent concessions put in place last year has been extended for a year due to the ongoing impact of COVID-19. It relates to accounting for temporary rent concessions for operating leases occurring as a direct consequence of the COVID-19 pandemic. Entities are required to recognise changes in operating lease payments that arise from COVID-19 related rent concessions over the periods that the change in lease payments is intended to compensate, rather than over the remaining term of the lease. The proposed amendments are restricted to lease payments originally due on or before the 30th of June 2022. You have just heard Megan mention the IFRS IBOR amendment, and it's good to know that there is a similar relief for FRS 102 reporters with contracts that reference LIBOR. Note for those of Euribor contracts, Euribor is not being abolished, and so contracts referencing this rate are unaffected. Interest rate benchmarks such as LIBOR are being reformed, giving rise to issues affecting financial reporting. These issues impact the period before the reform, particularly in relation to hedge accounting, which was addressed by Phase 1 last year. Further issues might affect financial reporting during the reform of an interest rate benchmark in respect of modifications to financial instruments, changes to hedging relationships, and modifications to leases. This amendment focuses on these issues. FRED 74 proposes amendments to the accounting requirements in various sections of FRS 102 to provide relief to minimise discontinuities in the accounting for financial instruments and leases, and avoid unnecessary discontinuation of hedge accounting as agreements are modified in order to transition to alternative benchmark rates. Entities will account for modifications as if they result from periodic re-estimations of cash flows to reflect changes in market rates of interest. These two amendments apply to accounting periods beginning on or after the 1st of January 2021 of early application permitted. In relation to Brexit, the FRC has published amendments to UK accounting standards to reflect changes in UK company law following the UK's exit from the European Union that come into effect at the end of a transition period. As these amendments reflect changes in UK company law, they are not expected to introduce changes in financial reporting other than when required by law. There should be no practical impact on entities in the Republic of Ireland. Further information on the impact of Brexit was included in the Need to Know publication issued in December 2020. The final area to cover in relation to FRS 102 is the periodic review update, which is now commenced ahead of the issuance of a new version of the standard, which will be issued no earlier than the end of 2022 and effective no earlier than the start of 2024. Key sources of potential amendments are improvements required, including how the standards are working in practice, new issues or transactions that should be addressed, wider developments including restoring trust in audit and corporate governance, and changes in IFRSs including IFRS 15, IFRS 16, and the expected credit loss model under IFRS 9. The FRC are currently in listening mode and are seeking comments as to what they should do with these IFRSs as far as FRS 102 is concerned. The views expressed at the roundtables included that IFRS 16 should be adopted, but with suitable simplifications, especially as regards to the setting of the incremental borrowing rate. Similar comments were made for IFRS 15, in practice found to be complex to apply, but ending up with more or less the same result as previously. On IFRS 9, the sentiment seems to be that the ECL piece needs to be adopted, but again with appropriate simplifications. I'll now hand you over to Maeve to take us through the Streamline energy and carbon reporting updates.
Thanks, Grace. Earlier, David and Michelle set the scene around the focus on sustainability and climate change, both in government and across all businesses. I'm going to take a deeper look into the Streamline energy and carbon reporting regulations called SECR, which apply to the UK entities. These regulations detail a number of qualitative and quantitative environmental disclosures, which are required for quoted companies and large companies and LLPs in the UK. The regulations of SECR will be largely familiar to quoted companies, however, large UK companies and LLPs are now brought into scope. According to UK company law, large companies are those that meet 2 or more of the 3 monetary size limits, and they are turnover of more than 36 million, balance sheet total of more than 18 million, or more than 250 employees. There are also a number of things you need to consider if you're part of a group. A parent company will qualify as large if the group that it heads meets at least 2 of the thresholds just mentioned. This is an area to be careful of if you're part of a larger group that contains a UK subsidiary. The UK subsidiary may qualify as large either by itself or including the entities below it. And this is an area that could easily be missed, particularly if the top company is not a UK company. And finally, you need to consider which entities will be included within the disclosure. There are some differences on the requirements from quoted companies compared to unquoted companies. Quoted companies are required to disclose their global greenhouse gas emissions and energy consumed, whereas large companies and LLPs are only required to disclose that information for the UK and the offshore area, being the seas around the UK. Quoted companies are then required to disclose the proportion of their emissions and consumption which relate to the UK and the offshore area. If you're using the greenhouse gas protocol, which is one of the most common methodologies, the emissions are split into 3 different scopes. Quoted companies are required to report their scope 1 and 2 emissions, although strongly encouraged to report scope 3 emissions. We'll now take a deeper look into some of the more practical considerations of applying SECR once you've determined that you're in scope. You need to consider the boundary of your data collection, i.e. how far to go with collecting the data, which can be particularly challenging for scope 3 emissions. You need to ensure that you've got appropriate processes in place to capture the data in a clear and quantified way. In terms of assurance, there is no statutory requirement to assure environmental data. However, government guidelines have highlighted the reputational risk to disclosing misleading data. In terms of format, there is no prescribed format. However, there are a number of templates available, including within the Deloitte model financial statements. There is a difference between location-based and market-based emissions. Location-based reporting utilises the electricity grid average emissions for the area, whereas market-based emissions would include the entity's specific tariff. Reporting by segment or business unit may be useful if you're in an energy-intensive industry, such as mining. And finally, the government has recommended going beyond compliance-based reporting and setting forward-looking science-based targets. The FRC recently released a review which considers how a sample of preparers complied with the new SECR requirements, highlighted emerging examples of good practice, and set expectations for future reporting periods. A key theme with the omissions and errors was that there was insufficient information disclosed for users of the statements. This was around areas such as the methodologies used, the entities included in scope, the level of third-party assurance obtained, and the principal measures taken by the entity in the current year. Examples of good practice, however, included areas that were encouraged by government guidelines. This included Scope 3 emissions, information about renewable energy, and disclosure of both location-based and market-based emissions. Many reporters did set out emission reduction targets or an intention to set targets. However, better practice examples explain terms like net zero or other emission reduction targets and strategies. This included interim pathways and detailed metrics. The full report is available, which I definitely recommend reading, on the FRC website, and a link will be included within this slide deck. Finally, we have a number of other resources in the slide deck which will be useful to you in preparing this disclosure. Now we're going to hand over to Emma Arlo and Ashley Nicholson for a corporate tax update.
Thank you, Maeve and Grace. My name is Emma Arlo and I'm a Director in the Tax Policy and Technical Services team, and I'll be sharing an update on corporate tax in the Republic of Ireland. For those of you interested in corporate tax in Northern Ireland, we have a dedicated session on our Plus stage led by my colleague Aisling. To join our Northern Ireland session, please click on the icon to the left of your screen titled Plus stage. If you would like to listen to both sessions, recordings will be available on our DFRP webpage following our conference. The key Irish corporate tax changes were introduced in this year's Finance Bill, released on 21st of October, and at over 200 pages in length, there are a variety of changes of interest to companies, but a key change of note is in the introduction of interest limitation rules into Irish law. The interest limitation rules are required by the EU Anti-Tax Avoidance Directive, the purpose being to prevent base erosion through the use of excessive interest deductions by companies, and it achieves this by limiting tax relief on net borrowing costs to a set 30% of their tax EBITDA. It is open to taxpayers to apply the rules either on a company-by-company basis or to an interest group, which refers to either a worldwide group for accounting purposes or a group for local Irish loss relief purposes. The interest limitation rules apply to Irish resident companies, non-resident companies with an Irish trading branch, and non-resident companies that own Irish rental property. The rules operate by limiting the maximum deduction for net interest expenses, both bank and shareholder loan interest, to 30% of earnings before tax, interest income, interest expenses, finance lease payments, depreciation and amortisation. In comparing the maximum allowable amount to the net interest expenses, a taxpayer will have either a disallowable amount that will reduce the tax relief on borrowings, or the taxpayer will have an amount of spare capacity. Where the deductible borrowing costs of an Irish taxpayer are restricted in an accounting period, the restricted or disallowable amount can be carried forward to succeeding accounting periods indefinitely. Any additional spare capacity can be carried forward for a period of up to 5 years. The rules will be effective upon the signing of the Act for accounting periods commencing on or after 1 January 2022. The operation of the rules are subject to a number of exemptions and exclusions. Where an Irish taxpayer is part of a consolidated worldwide group for accounting purposes, the indebtedness of the overall group at worldwide level may be considered for the purposes of providing additional relief. These are the group ratio, which allows the 30% cap to be increased if the group's interest to EBITDA percentage is greater than 30%, and the equity ratio, which disapplies the interest limitation rule to allow full relief for net borrowing costs where the entity ratio of equity over assets is greater than the group level. In certain cases, the interest limitation rules will not apply. These include where the Irish taxpayer's net borrowing costs are less than €3 million, where a company is a standalone company, being a company that has no associated enterprises or permanent establishments, interest on legacy debt, being debt the terms of which were agreed before 17th June 2016, and where the relevant entity carries on a qualifying long-term public infrastructure project. So this is a theory, but what does it mean practically? Practically, it means that the amount of tax relief on interest will now be limited, with the impact either being felt in an increased corporation tax charge or reduced losses available to carry into later years. What is important to remember here is that the disallowance that arises is not intended to be permanent, but rather a temporary deferral of a certain portion of tax relief on borrowings. The revised rules in the bill still have some road to run before they come into law, but once the Act is signed in December of this year, the rules will apply for accounting periods commencing on or after 1 January 2022. So while we won't likely see any substantive changes in financial accounts for 2021, the imminent changes will likely require a mention or a disclosure at the very least. For 2022 onwards, the focus will be on ensuring that CFOs and their teams are up to speed on the changes so they can model the impact early in the case of new or existing financing arrangements and the associated tax relief on same. Another key development to be aware of in this year's finance bill have been the revisions to transfer pricing rules, in particular the treatment of non-trading transactions between Irish associated persons. By way of a recap, transfer pricing governs the price paid on transactions between associates. For example, the rate of interest a party might pay on a loan from another company within the same group, or the amount of rent payable to a property holding company in a property rental type agreement. The transfer pricing rules prior to 2019 were limited to trading transactions only, but amendments in Finance Act 2019 extended the rules out to non-trading transactions with an exemption for purely Irish-to-Irish domestic non-trading transactions. The way in which the exemption is worded in the Finance Act 2019 would have primarily rested on the words chargeable to corporation tax in respect of the profits, gains or losses arising. And this begs the question as to what happens when there are no profits or gains or losses that arise from the transaction. For example, on screen now you have two Irish companies, one lending funds interest-free to another. There is no interest rate applied, so no interest income in one and no interest expense in another. So technically no profits, gains or losses. And the question which dominated the conversation for a lot of last year was whether you need a notional amount in order to avail of the exemption. Indicators at the time suggested a view that in order to avail of the exemption, there had to be a source of income generated from the arrangement. So a purely interest-free loan might not be able to avail of the exemption in the absence of income being generated. Fast forward to this year's finance bill, where these provisions appear to be redrafted, and the current drafting in particular now seems to do away with this requirement for there to be income, and it puts the exemption on a somewhat clearer footing. The result being that it is likely clearer than ever that purely interest-free loan agreements or similar rent or royalty-free agreements may in fact be able to avail of the domestic exemption from transfer pricing. So from 2022 onwards, the position does appear to be clearer, such that an income stream may not need to be booked in the accounts, but we will watch this space with interest. Aside from the changes in the finance bill, which are still being analysed technically, a key development on the horizon for CFOs focuses on the global tax reform at OECD level. There has been considerable media attention on this in recent weeks, so I will briefly touch on what this means for Irish companies. There are over 24 technical meetings to be held on this topic at OECD level between now and the end of the year. The global agreement reached is comprised of two pillars. The first pillar looks to the reallocation of taxing rights in favour of market jurisdictions, also referred to as Amount A, while Amount B of Pillar 1 looks to provide a set remuneration for baseline marketing and distribution activities. The agreement reached on Pillar 1 has been reached on the basis that the unilateral digital services taxes imposed around the world are to be gradually phased out. This will be of interest to Irish headquartered companies who have found themselves affected by the digital service taxes levied in other countries, particularly from the perspective of tax positions taken by both tax advisors and auditors on whether such expenses may be viewed as tax deductible. The more pressing update for companies, and in particular Irish companies, is on Pillar 2. This pillar comprises a set of interlocking rules to ensure that large multinational businesses pay a minimum effective tax of 15% on profits globally. Multinational groups with consolidated revenues of at least 750 million will be in scope. In particular, the 15% point was a key focus of the Department of Finance in recent weeks, with an eventual agreement reached right before Budget Day. What is the timeline for these changes? In short, we will likely see a lot of technical work on this, with the next 12 months in particular being particularly busy. A multilateral convention to implement Amount A of Pillar 1 is expected to be developed in early 2022 and made available by mid-2022. Model rules on Pillar 2 are expected to be developed by the end of November 2021, with a framework for coordinated implementation developed by the end of 2022. What does this mean for Irish companies, and in particular from an accounting perspective? Right now, nothing has been substantively enacted as yet in the Finance Bill. The Finance Bill made no mention of the imminent changes as expected. However, we would expect that accounts prepared for 2021 will require some form of narrative to identify and address the changes. In particular, we are also seeing increased efforts from multinational companies to engage in modelling to identify the bottom line impact of the rules. This modelling will likely become more frequently used in the future as the technical work continues. I'll now hand you over to Donal, who will take us through data protection.
We might just wait a few seconds to allow people to return from the Northern Ireland tax session on our Plus stage. As a reminder, if you would like to view the Northern Ireland session, a recording will be available on our dedicated DFRP webpage later today, along with all the additional resources referenced throughout our session. I've been given the thumbs up that we can now begin. Thank you, Emma and Aisling, for those tax updates. My name is Donal Murray, and I'm a partner in Deloitte's risk advisory practice. Today, I'm going to quickly cover what we are seeing in the world of data risk and data protection, and I'll then focus on one of the biggest hot topics across all industries at the moment, and that is ransomware. The data world has never seen so much turbulence and unrest, and this will likely continue into the future unless we are more rigorous in how we are protecting it. And there are many factors that have created this turbulence. Firstly, COVID has changed the way we are operating. We have many people working from a remote location with data now in transit for longer periods of time. Technical solutions to facilitate remote working and remote data access have been tried, tested, and in many situations upgraded and implemented for the first time. This has meant more interfaces to organizations' data and therefore greater risk. But COVID is also accelerating the technology revolution. Digital, for instance, has been on the agenda for many years now, but as customers are trusting online channels more and more, the race to present the best customer experience has moved from a marathon to a 100-meter sprint. But these new technologies are interacting with data and ingesting data in ways and volumes that we have never seen before. And this is creating a fractious relationship between technical innovation and data regulation. So as we're observing these significant changes in how we do things, we are now seeing a regulator that is beginning to show its teeth. Over 1 billion euros of fines have been levied in Q3 21, 3 times as much as the previous quarters. So it's an interesting dynamic of COVID disruption, significant data change and usage due to technology revolutions, and a regulator that is more experienced and more focused on key risks. And this is why the GDPR was released. The Commission recognized that previous acts were too archaic in dealing with how data was used in this technology age. What we're seeing across organizations is a realization that what the GDPR mandates, such as privacy by design and data protection impact assessments, is absolutely necessary in order for organizations to innovate while also protecting the rights and freedoms of individuals. Extensive privacy by design frameworks are now being implemented by organizations across all industries, and this is likely to continue. And of course, there is the great white shark circling the perimeter, the criminal groups who have identified opportunities to not just exfiltrate data, but also take down businesses for a period of time. We can't talk about data risk today without talking about ransomware. And as we know, ransomware presents many more significant risks beyond that of privacy and confidentiality. As our technology is becoming more sophisticated, as I touched on earlier, we're also seeing an increase in attack sophistication, with advanced malware capability being able to exploit intrinsic vulnerabilities in our systems. It's very interesting also if we consider 2017, when the financial services sector was the primary focus for attackers. But as we've moved into the digital age, it has opened up many other industries, with the biggest impacting ransomware attacks being in industries such as logistics, manufacturing, oil and gas, and of course, the public sector. The financial services sector has been at war for many years against cyber criminals, and these new targeted industries are now having to learn fast in order to protect themselves. The key thing here is that ransomware presents many risks: financial implications, reputational damage, data leakage, and a significant operational impact. And these attacks are becoming so frequent that it has fast become the #1 risk on audit committee agendas and CROs' registers. So what are companies doing to deal with ransomware attacks? As ransomware presents many risks, the key is to reduce the risk of extinction level impact. That is where the company could lose a significant component or all of their business. Now, what we're seeing at the moment is that this extinction level is being achieved, certainly for a period of time, by many attacks where businesses are being brought to their knees for a considerable period of time. Take, for instance, the oil pipeline in the States or the health service here in Ireland. Reducing that risk first and foremost is critical, and then moving to other high-risk areas such as fraud, brand damage, or personal data leakage is the step after that. It's the implementation of the right balance of preventative and detective controls. What we see in this slide is a bow tie model that you would typically see in a safety and engineering environment that we are now using and applying to a cyber context. The left side is critical in reducing the risk of these sophisticated attacks penetrating the company, narrowing or funneling the risk to an acceptable level, while the right side is the response element set up to deal with what the preventative could not contain. In the past, an awful lot of focus and investment went into the left preventative side with not enough thought given to the response element. There is acceptance now that an attack at some stage will penetrate your company, and it's the company's ability to respond effectively that will protect its brand, its business operations, and its data, and ultimately reduce the risk of extinction level. Under the assumption that an attack will occur and will impact, for each service within your business, what is the acceptable level of disruption? This means defining a desirable recovery time and a tolerable recovery time for each service, and these recovery time objectives drive the investment you make into response and recovery solutions for each part of your business. Rather than believing you will not be hit, assume that you will be hit and understand how your business will fare when under attack. It's essentially setting a priority list of recovery activities. The current average recovery time that we're seeing across all industries is 23 days. Is this acceptable to your business, or does it go beyond the tolerable level? What's really interesting is that while the tech revolution is introducing additional risk, it's also being used to reduce the same risk. Machine learning is being used to develop advanced preventative cyber controls, while moving to the cloud and using software as a service protects your data and your service in the event of networks being penetrated. What is a concern, though, is if ransomware attacks manage to penetrate the cloud, therefore impacting on potentially hundreds, if not thousands, of companies worldwide at the same time. What is certain is that we will continue to see ransom attacks occurring, and it's the company's resilience measures that will decide how successful these attacks are. I'll now pass you over to John McCarroll, who will close our conference for another year. Thank you.
All right, thanks, Donal. So just in closing, Oliver and I were reflecting earlier that we've been working on this conference for 10 years now, and we've been focused, every year on change. I think this year change is underestimates what we're facing. I think it's more fundamental. There's a huge shift, and in particular, some of the the issues around climate change, etc., are really going to fundamentally change our world. Those issues were signposted by Michelle and David. I noticed, I've noticed even over the last number of days, the rhetoric on this has hugely increased. With press and focused on investor and stakeholder expectations. And I have noticed that in the financial services world that I operate in, the regulator has become a lot more awake to this and is now very focused on it. So that climate piece is really significant. Our speakers have signposted the other areas: crypto, technological change, the ever-present threat of cyber, and layer onto that, we've got economic headwinds around inflationary pressures and supply chain. It can feel a little bit overwhelming. And as we know, a lot of the burden on change falls with the finance function in terms of reporting and strategy. But I'm actually optimistic. I think that with change comes opportunity. We can hold a vision of a better world at the other side of it. What I would say to you is, look, we've signposted things today, but we're here to help. We can provide you a lot more information and resources, please contact us, any one of us, if you want more information. I would ask you to provide feedback, if possible, on the link. And with that, I would say thank you to all our speakers. I thought they were excellent, and thank you to you for attending.